Hey everyone, and welcome back to the Legal Insight podcast by HHQ. For those joining us for the first time on this podcast, this is a podcast where we attempt to thoughtfully dissect developments across law, business, technology, and everything in between. Now, in a manner that hopefully makes sense to everyone else. Whether you're an in-house counsel, senior management, a member of the board, or simply working professionals who want to keep up with the rapid developments around us while filtering out the noise and focusing on what truly matters. Today, I'm very pleased to be joined by two very familiar voices from our technology practice group here at HHQ. We have Ong Johnson, the head of technology practice group, and Lo Khai, the co-head of technology practice group. Welcome to the show, guys.
Good to see you, Zach. Always a pleasure to be here.
Yeah, it's so great to have both of you always. In today's episode, we will be discussing what is probably one of the most crucial topics currently gaining serious attention in the market, particularly among financial institutions, which is tokenized money. There's little doubt that in 2026, we're slowly shaping up to be a foundational year for tokenized money, especially following the recent developments involving the Digital Assets Innovation Hub, DAIH, under Bank Negara, Malaysia. But if you have no idea what tokenized money actually is, or if you have heard of the term but never quite understood how it actually works, then this episode is very much for you. Today, we will be exploring what tokenized money actually means, how the ecosystem is developing in Malaysia, and how financial institutions may start positioning themselves strategically for what is likely to become an increasingly important part of the financial landscape, not just in Malaysia, but beyond. Given the depth of ideas we will be discussing today, we'll actually be splitting this discussion into two episodes. So tune into this one and the next episode as well to get the full picture. With that, gentlemen, let's jump straight into it. I'll start with you, Johnson. Johnson, perhaps the most natural place to begin with is the fundamental questions. We hear this term tokenized money being used a lot and increasingly in conversations around fintech, digital assets, and financial infrastructures. But for many people, it still sounds like an abstract term. So perhaps to set the stage for our discussion today, what is tokenized money?
Amazing way to start. So if you're listening to this episode and you're a bit confused or you have never heard of tokenized money, I think it's totally okay. The reason because tokenized money is a very new term in Malaysia. So if you want to look back at the source, or we call it the origin of tokenized money, we can actually trace back to last year, October 2025, whereas BNM or DAIH, they actually first issued a discussion paper. The title is called Asset Tokenization in the Malaysian Financial Sector. That is the very first time where tokenized money is formally being introduced by our regulator, BNM. Within that paper, tokenized money, we are able to actually tell it very clearly. For our BNM, they are seeing tokenized money into three very broad categories. The first one is going to be CBDC, and after that is stablecoin, or one that we actually discussed in our previous episode as well. And the very last form of tokenized money will be tokenized deposits. In other words, you can see tokenized money into three categories: CBDC, tokenized deposit, or otherwise stablecoin.
Right. That's super helpful, Johnson. But as you mentioned earlier, there are several different forms of tokenized money, right? You mentioned CBDCs, you mentioned stablecoins, tokenized deposits. So for many people listening, these are also still somewhat like an alien language. So perhaps you could help us unpack this a little further. What do these three forms actually mean in practical layman terms? How do we use it? What is it actually stand for?
Yeah, very happy to. So as I mentioned, there are three different categories. So the first particular categories will be CBDC. CBDC, we can understand it as a central bank money, or money that's being issued by central bank on one key condition. It means that it's actually being issued by central bank on blockchain. Different countries, you can be issuing your own CBDC. For example, Singapore, US, Vietnam, Thailand, even Malaysia, we could be issuing our own respective CBDC. And one of the key conditions is CBDC, it must be issued by the central bank alone. Naturally, in Malaysia, our central bank is BNM. Only BNM could be issuing CBDC. Moving to the second category, which is what we mentioned, stablecoin. Stablecoin, the name itself is quite self-explanatory. It is a token that is being issued on blockchain as well. And then the understanding of stablecoin is it's supposed to be stable. Similarly, when it comes to stablecoin, different country could be issuing their own stablecoin as well. That is why we have different country denominated stablecoin, like in US, we have USDT, USDC, and then in Singapore, their own stablecoin. And then in Malaysia, if our country want to issue our own stablecoin, naturally it has to be MYR denominated stablecoin. The underlying or the fundamental understanding of stablecoin is supposed to be pegged to the current, our currency. So it's always supposed to be one-to-one. The way they're doing is you're going to have a reserve, and then with that, you are doing your own issuance and also maintain on blockchain. Then with that, you are able to ensure that the token is always pegged one-to-one when it comes to value. But of course, we understand in the past there are a lot of nonsense, a lot of those stupid coin in which those stable coin not stable, and then they eventually collapse. One great example that we discussed multiple times is USD. So USD is supposed to be algorithm stablecoin, and then it collapsed, actually causing billions of actually damages. And then the very last one is we also discussed previously, which is tokenized deposit. Tokenized deposit is a bit different comparing to stablecoin and also CBDC. When it comes to tokenized deposit, the fundamental understanding will be a financial institution. They are actually tokenizing the deposit of your client. So for that, maybe you are using CMB, maybe you're using Maybank. So what you can do is, I'm sure they are saving their deposits inside the bank. So banks, they are able to tokenize your deposit and then be using your deposit for whatever purposes, whether for payment, settlement, or even remittance purposes. And only one kind of entity will be able to issue tokenized deposit, which is banks. The reason because only banks, they are able to collect deposit as a business. That is why, depending on the entity, depending who you are, if you want to venture into tokenized money, then you can explore either one of these two paths. It's either stablecoin or otherwise tokenized deposit, because only BNM can touch CBDC.
Yeah. Right. Thanks, Johnson. That gives a much clearer picture on the foundations of tokenized money. Now, Khai, let's bring the discussion closer to what is currently happening in Malaysia. We understand that Bank Negara has established the DAIH, right?
Yeah.
And that several financial institutions have already taken, have already been admitted into what many people refer to as the DAIH sandbox. Could you tell us a little bit more about which financial institutions are actually involved and what are they actually experimenting with in this sandbox?
Yeah. Sure. So shortly after the issuance of the discussion paper by the DAIH, the earliest announcement that we heard was from Standard Chartered and Capital A, right?
Yeah.
I believe it was late last year. They released a joint statement saying that they have been formally admitted into the DAIH sandbox, or rather to be a part of DAIH to test out what they term as the use of a stable coin for B2B settlement. Of course, we don't know the detail. All we know is whatever that the companies have published on their joint statement. But from what we could surmise, essentially the focus here by Standard Chartered and also Capital A is to test out the use of stablecoin for wholesale, in relation to wholesale use cases. We are talking about transactions between financial institutions here. Let's say a bank A is buying bond from bank B, and then how does that transaction then be settled? One party need to transfer the bond, and the other party needs to obviously pay. In this case, payment will likely be in the form of stablecoin. So how does stablecoin then facilitate the settlement of this sort of large-scale institutional transactions, wholesale transactions, B2B transactions? Whereas for the other two banks, they are Maybank and also CIMB. Maybank is partnering with Yinsen, and both of them, they are testing out their testing use case in relation to the use of tokenized deposit. So when it comes to the other two financial institutions, they announced their statements slightly later, sometime in early February. So both Maybank and CIMB have also announced that they have been formally admitted into the DAIH sandbox to test out their initiatives. And both of them, they are testing the use of tokenized deposits, as what Johnson has mentioned just now. Essentially, users will go to them, you deposit your cash, and in return, they'll most likely be giving you some form of token representing the deposits that you have put with the banks, Maybank and CIMB in these cases, right? So Maybank in particular, again, we don't really know the specifics. All the information that we have at this moment is whatever that they've published in their joint statement. Maybank, they are using tokenized deposits for cross-border payments. So in this case, they will have to test the use case, the transaction, the remittance part with foreign banks. From what we know, again, the joint statements say that they are testing it among the ASEAN countries. Specifics, we have to wait and see, right? CMB, on the other hand, they are trying to use tokenized deposits to support end-to-end payment and also settlement. So this could be just B2B transactions, merchant paying supplier, for example, using tokenized deposits. So that's all that we know so far. From our standpoint, we think that this is a good development, of course, because it's I would say the first time in Malaysia where there is actual institutional adoption of tokenized money. And this may well just be the first step to see how policy can be shaped and how BNM may potentially be regulating the entire industry.
Fascinating. Now, I understand that you and Johnson have also been extremely busy and advising many companies on tokenized deposits and stablecoins. And I know that personally, you both have also been dealing very frequently with DAIH on many projects. But Khai, from our internal conversations, we also often hear that issuing stablecoins or tokenized deposits is only one part of the story. So the natural question then becomes, what is the end game here? Is it just token issuance? Is that the main opportunity, or is it only one component to it? Is there a bigger picture that we are not seeing yet?
Yeah. So oftentimes, whenever Johnson and I we have conversations with banks or whoever, they will also be asking these questions, right? Is this the be all and end all? Is the tokenized money be all and end all? Our answer is always that is not actually the case. This is only the first step to a broader ecosystem. An example that we always use is cash, right? Cash is not the be-all and end-all. It is just an instrument for parties to carry out transactions. So in this case, tokenized money, its feature is very similar to cash at the end of the day. So I would like to break it down into 4 layers, actually. When it comes to tokens, that is only the first layer. You have the token layer, and then you have the underlying infrastructure layer. Then you have the services layer. And lastly, I would say the use case layer. So token layer is only the first layer. It gives you an instrument whereby you can then use to make transactions. But someone need to maintain the infrastructure. Someone need to put in place an infrastructure so that this instrument, this so-called digital cash, can be used for transactions. Someone need to be doing the settlement. Someone need to be doing the tokenization itself. So the second layer will be the infrastructure layer, where things like tokenization platforms, blockchain infrastructure, and also settlement rails exist. Then comes the next layer, the services layer that I mentioned just now. One very clear example that I can give would be in terms of custody. Holding on, providing services surrounding the management of the assets, surrounding the management of tokenized money in this case. Custody would be the clearest example. We've seen Bank Negara talking about it. We have heard securities commissions talking about it. So I think custody is something that people would be rather familiar with at this point in time. Essentially just a group of people holding on to tokenized money, in this case, on trust, for the benefit of whoever, a beneficiary. And the last layer would be the use case layer. And this is where we kept talking about cross-border payments, remittance, trade financing, B2B settlement. So this is where the tokenized money will be widely used and put in circulation. So at the end of the day, think of it this way. You won't have many people be issuing token. I think in terms of issuers, the numbers relatively in the entire ecosystem will be few. But many people will be participating in the layer 2, layer 3, or layer 4. So that's how the entire ecosystem can work. It is only where there are a lot of use case, there are a lot of activities, then only there will be, I would say, a good and healthy ecosystem for tokenized money in this case to exist and for wide adoption.
So Khai, you mentioned just now about infrastructure supporting tokenized money. So maybe I'll pose this question to Johnson. I want to zone in a bit on infrastructure. Is it fundamentally different, the infrastructure that supports tokenized money compared to what we have, traditional financial institutions, traditional payment infrastructures? Is it different from what we're familiar with today?
Yes. Very good questions. Fundamentally, I would say that it's actually very similar, but when it comes to the technical aspect, it's totally different. So just allow me to break it down from a very simple layman understanding. When it comes to the fundamental perspective, just like how we have been using e-money, in order for me to send e-money, let's say from Johnson to Khai, Johnson to Zach, I will need like the payment system or the payment infrastructure in order for me to allow that particular transactions. However, from a technical perspective, in order for me to be transferring my stablecoin or otherwise tokenized deposits from Johnson to Zach to Khai, am I able to be using the traditional payment infrastructure? Unfortunately, the answer is no. The key difference between what has been built in the past, for example, e-money, credit card, or debit card, the traditional kind of fintech comparing to the new fintech, which is blockchain, the key difference is actually the infrastructure that is actually being built. In order for me to actually do any form of transaction, any form of transfer using stablecoin or tokenized deposit, I can only do it on blockchains. And the key difference when it comes to blockchain is there are different kind of chains in the market. Let's say in order for me to actually issue any form of stablecoin, any form of tokenized deposit, number one, I will need to choose the kind of blockchain that I want to build on. And then I can only be transferring or doing transaction on that blockchain, the native blockchain or otherwise blockchain that is compatible. That is the key difference. That is why a lot of time when we are speaking to banks, they feel that, look, I want to actually issue stablecoin. But after issuing stablecoin, the next question is, they'll be asking, but how about the payment infrastructure? How about the payment network? Am I able to rely on the traditional payment infrastructure that we have already developed? Unfortunately, the answer is no. The reason because you have to pick and choose the right blockchain or otherwise the blockchain that is compatible.
Understand, Johnson. Now naturally, this leads to the commercial question. The obvious commercial question is, where does the money come from? Where does the revenue come from? Where is revenue generated for these financial institutions actually going through the pain of issuing these coins, building the payment infrastructure, building the infrastructure just supporting these tokenized money?
Yeah. So we can really understand the entire thing as using a very simple example that everyone is very familiar with. We can be seeing stablecoin or tokenized deposit at cars. In order for us to drive those cars within highways, right? So the payment infrastructure, the payment network are essentially the highways. Then you ask me, for highways, why do we build highways? How are we supposed to make money? We are making money whenever we pass by tolls, then they'll be taking a very small cut, whether it's a $2 or whatever thing. Then similarly, in order for me to make any transaction on blockchain, then I need to pay something we call as gas fee. Or for the more financial term is transaction fee. Whenever a transaction is being conducted on that particular blockchain, then a small fee, a small gas fee will be generated. And that is exactly how those people who is operating the blockchain will be able to generate their profit and also their revenue. Just like highways, different highways, you are able to generate different sum. Then different blockchain, depending on the uptime, depending on the adoptability, depending on the speed. Some people will prefer to build on different kind of blockchain. So we really foresee that in the market, naturally certain blockchains will be gaining greater market share. And then the moment you have greater market shares, more people will want to use that particular blockchain with higher transaction, higher volume, then higher revenue and higher profit as well.
Amazing. Now, Khai, let's turn to another layer of the ecosystem, right? Which is merchant acceptance.
Yes.
If there's no merchants using it, like how a transaction is supposed to be facilitated.
Yes,
So if stable coins or tokenized deposits, they're going to eventually be used for everyday payments, then the question becomes how merchants actually accept them.
Yes.
You mentioned things like credit cards, Visa, MasterCard, but what exactly is the merchant acceptance layer in the sense of tokenized payment systems?
So now let me try to speak more English rather than foreign languages or Martian's language or whatever foreign languages that we've been speaking in the past few minutes, right? Essentially, merchant acceptance layer in a merchant acceptance layer in the tokenized payment system, it is referring to the infrastructure and services that allow merchants to ultimately accept digital tokens or tokenized money as payment. So think of it in a real life example. Before we talk about tokenized money, maybe we use the current way of us buying char kway teow with a card, right? Let's say you want to buy a char kway teow and the char kway teow seller actually allows you to pay using your credit card. So they have a card terminal system.
Yeah.
And you actually go to them and pay using your credit card. So in this case, from a user's perspective, it's all good and easy. The moment I tap from a user's perspective, I know that my card will be debited with a certain amount, and the bank account of the seller will be credited with a certain amount equivalent to the price of a char kway teow. But the underlying processes is actually a lot more tedious than that. Someone will have to carry out the processing backend, liaising with my card issuing bank to confirm that, hey, there is this transaction that your customer is trying to request, and are you going to approve it? Then the issuing bank will say, yes, this person the credit card has enough allowance, so to speak. You can go ahead and I approve these transactions. Then the middle person who is communicating with the bank will then take that money in a sense and pass it on and transfer it and convert it into actual money in the bank account of the char kway teow seller. So all these things happen within seconds, right?
Yep.
So essentially, in a normal fiat use case, this is how merchant acceptance layer work. So you have that middle person, and that middle person, we call them merchant acquirers.
Yeah.
So in the context of tokenized money, the same thing needs to happen as well. Let's say I am able to go to char kway teow seller, and in this case, to pay for my char kway teow using tokenized deposits or stablecoin, a middle person will still need to exist to make sure that the tokenized money from my wallet ultimately gets converted and gets transferred and exists in the form of, let's say, fiat or ringgit in the bank account of the char kway teow seller at the end of the day. Much like how merchant acquirers have been doing for fiat currency all this while.
All right, I get the full picture now. I mean, part of the picture, but at least I know what I'm going to have for lunch later, which is very interesting. I understand that many financial institutions are already registered, as you say, merchant acquirers. So, Khai, if stablecoins or tokenized deposits eventually become part of the retail payment landscape, how can these institutions leverage their existing networks and infrastructure to actually position themselves strategically for this, transition?
Yeah. So in a sense, the way that we see it, if I may assume myself in a position of the banks, right? Essentially, I am already registered merchant acquirers. I already have certain infrastructure in place. I have the merchant onboarding structure. I have the POS acceptance structure. I have a whole host of compliance network, which Bank Negara has compelled me, or rather has mandated me to have. I have the payment settlement capabilities, and I have established merchant relationships with whoever that is using my services, right, to acquire transactions in this case. So all that is left for me to do is to activate the blockchain components in all this infrastructure that I already have in place. So if I may, from the banks and from the financial institutions' perspective, or rather in this case, more specifically from the perspective of registered merchant acquirers, it is very easy for them to now diversify and extend their services from just fiat currency to also tokenized money.
Right, fascinating. So, well, gentlemen, this has been a very interesting episode, but I must say this is a lot for us to digest, and I need my lunch, right? Char kway teow lunch specifically. And we're really only halfway through the broader tokenized money ecosystem. Now, in the next episode, we will continue to explore even more layers of the tokenized money economy, including cross-border remittance, digital asset custody, and how financial institutions may strategically position themselves to ensure they're not left behind as this ecosystem continues to evolve. So if you found this discussion helpful, do make sure you tune in to the next episode where we dive in deeper into this ecosystem. Until then, thank you very much for listening to the Legal Insight podcast by HHQ.